Dividends, a much more controversial topic than it ought to be. Like every other investor, I went through stages when it comes to dividends. Brand new investors think they're the greatest thing in the world, then later they think they're useless because you can make more money using the buying power for other strategies. And then they come back and realize dividends have their place. The market is kicking off 2022 with its worst start to a year since 2008. Most active investors now probably weren't even trading back then, so this is the worst start to a year ever in most investors' lives. And now we're starting to see talk of this shaping up to be another March 2020, when half of you probably started investing. The theoretical best answer when markets are dropping is to invest more in growth. Be greedy while others are fearful. But a lot of investors are realizing that when you don't have a chart that looks forward 5 years, buying the dip is a lot harder than it sounds. To be calm, balanced, and focused, I find it ideal to have a blend of growth plus dividend income paying me out each month like clockwork rather than just throwing money into this sinking knife hoping for a rebound. Let's talk a little bit about dividends, and then I will show you my overly complicated dividend portfolio and give you some pointers. In case you've been living under a rock, a dividend is a cash payout that a company gives you for owning its shares. Don't forget that you as a shareholder technically own the company, so congratulations, you paid yourself. Companies that pay dividends tend to do so on a regular schedule and will often increase their dividend amounts. There's still risk to owning dividend stocks because you are still at the mercy of the market. But this is pretty darn close to truly passive income, and you will absolutely trade better when you have dividend income as a tailwind. Here's my broker's estimation of what my dividend income will be for 2022. In all my accounts, I'm averaging about $1,100 a month, but it varies depending on which company is paying dividends that month. My goal is to reach $21,600 per year in dividends after tax, since that's what I think it'll take to pay for my mortgage. Passive income paying your mortgage. People make TikToks selling that idea to pump their pyramid schemes, but I think you're much more likely to achieve it with dividends. Okay, here's my non-retirement account with Merrill Lynch, and this holds all of my dividend holdings in it. So we're just going to go down the line, and we're going to check out some of my favorites. Hopefully you'll find something on here that you also like and would like to add to your dividend portfolio. If not, I'll do a piece at the end where we can talk about how to find other opportunities. So the first one up, probably one of my favorites, is Coca-Cola. The ticker is KO. KO has increased its dividend for 59 years in a row, meaning that any investment that you make now is not only probably going to pay you every quarter for the rest of your life, but also increase the amount of money it's giving you every year. Interestingly, the stock just made it past its pre-COVID highs. So this is a very, very slow-moving stock, but it's probably also one of the most resilient names in the market. According to Stephen Fiorillo on Seeking Alpha, which is now my go-to for analysis, there are plenty of reasons to be bullish on the stock in general. But we're focused on the dividend. So with a 42 cent per quarter dividend and rising each year, we can be confident that we're getting good value here. But now that the stock has risen, its dividend yield is now below 3%. It's about 2.75. So the amount of dividend the company is paying has increased, but not as much as the stock price has increased. So proportionately to the stock price, that 42 cent per quarter dividend is now below 3% of the stock price. That means that if the stock comes down, that dividend yield will increase. If the stock comes down enough that it starts paying more than 3% annualized again, I'll be looking to buy more shares. And I think that this is possible during this pullback. I still think it's a good buy now, but it'll be even more so if it drops and the dividend goes above 3%. So my recommendation, start averaging in now and then look to add more as the stock drops. All right, the next one up is Energy Transfer ET. It's there right above KO. ET owns most of the oil and gas pipelines in the US and is right now paying a 6.3% dividend. So that's really high, but that's what its board of directors believes is going to be sustainable for the company after it's done some financial restructuring in 2020. Oil really struggled for a while, but fossil fuels are still king in the energy industry, and oil tends to do well as we get out of the winter and go into the summer. People are driving more, people are flying, that sort of thing. I'm bullish on the stock, but I'm even happier with the dividend. I don't think the stock will struggle too much through this dip because the energy sector is pretty strong. So this is a good pick in the near term, but I really like its dividend over the long term. Technically, Energy Transfer doesn't pay a dividend. It pays a distribution because it's an MLP. That's Master Limited Partnership, not My Little Pony. All that means for you is that your broker is going to list the distributions separately from the rest of your dividends on other stocks. It's no big deal. You just follow it separately. Next, we have Altria and Annaly Capital. I don't particularly recommend these. I just like having a very wide breadth of stocks in my dividend portfolio so I get paid more often, but these are not the strongest performers. I think there's a little bit more risk here, but in exchange, you do get a higher dividend yield. Altria is a cigarette company, which is a struggling industry right now as fewer people are smoking, but they're making investments into the cannabis sector as well. So right now, their dividend is 7.6%, so I think it's going to be tough for them to sustain it unless their cannabis investments really take off, which is possible, but we're going to need some legislative support. Right now, we really haven't seen that. However, my favorite Seeking Alpha author, Asian Investor, thinks this is a really good bet. So keep it on your watch list. If Altria drops back to the low 40s, I'll start looking at picking up more shares. It's shown support there several times, and its dividend yield at that point would be well over 8%. Annaly Capital is a mortgage REIT, so it borrows money at a low interest rate, and then it purchases mortgages that will pay them a higher interest rate. So it makes its money off of that spread. Most of the mortgages that they buy are backed by the government, so it's got some cushion there. With an 11% dividend, it does pay you really well, but a lot of people have taken out adjustable rate mortgages over the last decade because they've been deceived by their banks into thinking that's the way to go when interest rates were at historic lows. And now that interest rates are going to start rising, I think that there's going to be people that are struggling to pay their mortgages. A lot of people are going to default. So Annaly might have to count on the government backing in order to actually get its mortgage payments every month. So I am a little bit skeptical on this one, but this is something to watch because it pays such a high dividend at 11%. It's a higher risk position, and that's kind of unusual. That's not really what we want from a dividend stock, but it is something worth watching. And if it does start to drop, I might pick up more shares. I think I'm more likely to sell than I am to buy, but I am going to keep it on my watch list. Next one up is PFFD. This is an ETF that holds a blend of preferred shares that act as a fixed income instrument. So this fund all but guarantees a monthly payout with about a 5% annualized yield at its current price. The fund is definitely going to underperform the S&P during a bull market, but the preferred shares and dividend will outperform during a sideways or a bear market. So it's great for fixed income investors. It's a great way to approach dividends when you don't expect a huge bull market in the future. I keep a pretty small percentage of my portfolio in this, but it is something that I'm interested in adding as we go ahead. The next one up is Prudential. The ticker is PRU. This might be my favorite dividend play. I timed the buy perfectly in 2020 by getting in when the shares were $65, and the stock is way up since then. It's about $113 now. The dividend right now is about 4%, so it's already on the higher end. So 4% is good, but Prudential has also demonstrated a willingness to continue raising its dividend every single year since this bull market cycle began. So even though you're getting 4% now, I think the stock is going to continue raising its dividend, and you'll receive even more in future years. According to Cody's Dividends on Seeking Alpha, Prudential is still undervalued, and its share price is probably going to increase as it raises its dividend. So I was lucky that I got in when the stock was cheap, so I'm getting about 7% yield on my shares. If you buy now, you'll be getting about 4%. If Prudential continues to rise in price, you'll be getting a lower percentage yield. So buying now will give you the opportunity to get in while the shares are still relatively cheap. This is a stock that keeps going up with the broader market, and it's recession-proof, so this is absolutely a winner. Buy PRU. THICC and QYLD, sometimes called the Quaaludes, are the ones I want to talk about next. They both sell covered calls on the NASDAQ 100 index. This gives them premium for selling the covered call, and then they distribute that to the shareholders. THICC sells covered calls on about half of its holdings, and Quaaludes sells covered calls on the whole thing, the whole holdings. As a result, THICC pays about a 6.5% dividend, and Quaaludes pays about double that, over 12%. THICC will grow more because it holds some of its positions in the index naked. It doesn't sell covered calls on the whole thing. Meanwhile, Quaaludes really doesn't grow at all. It sells covered calls on its entire position with at-the-money contracts. So which one do you want? Do you want growth and income, slightly lower dividend? Then go with THICC. If you just want income and you're not really worried about growth for that part of your portfolio, then go with QYLD. Keep in mind that Quaaludes also pays its dividend monthly instead of quarterly, so you can compound it faster. I've obviously made my choice with the Quaaludes. I have about $58,000 in it. It's about 12 times how much I have in THICC. I already have so much invested into growth already that I don't really need the additional growth from THICC. I had more than $58,000 in it last week, but since stocks have continued to drop and Quaaludes is dropping with the NASDAQ, I'm losing money on that part of the position. But I'm still gaining that dividend. And even though Quaaludes and THICC are both down, they're not down nearly as much as THICC. And that's because it's selling covered calls and it's receiving that premium for it. So it has a cushion against the index itself just dropping. On the downside, you're paying about 0.6% in fees to hold the Quaaludes, which is high. But I have someone managing my covered calls for me. I don't need to worry about managing a position. I don't need to worry about liquidity, anything like that. Someone does all that for me, and they give me 12% annualized dividend. So I'm happy to sacrifice that extra 0.5% in order to get the rest of that. If you really don't want to pay that higher fee, you can just wheel THICC yourself, but I do caution you, it's more complicated than it sounds, and it'll probably just underperform holding THICC. So you should only consider THICC and Quaaludes if you want the income and you don't want to manage the position yourself. If you like these two ideas, then there are entire channels for you to check out that are based entirely on Quaaludes and THICC. Just Google either of those tickers or YouTube them and you'll get a gold mine of information. And the last one is SPHD. So this is the S&P's high dividend, low volatility ETF. It keeps the holdings in defensive sectors and should hold up well in recessions. It pays about a 3.7% dividend. The expense ratio is pretty high at 0.3%, but this fund pays monthly, whereas most pay quarterly. So in exchange for the higher fee, you compound your dividend faster. Some people swear by SCHD or VYM, which are very similar funds from other managers. Check those out too and pick the one that you like the best. You don't need to buy all three of them unless you just really like getting paid frequently. And then if we switch over to my Roth, we have O, which is Realty Income. The company raised its dividend every quarter since its IPO in the 90s and has paid a dividend every month as well. Right now, its dividend yield is about 4.5%. It's basically a commercial landlord ETF, so you're getting paid rent money and you don't have to manage properties. Its share appreciation isn't too bad either. It does a pretty good job of keeping up with the market, and it's risen pretty much every year. Seeking Alpha's QuantBot calls it a hold, but seems to like it when its price is in the 60s. I'll be looking to pick it up in my non-retirement account if the shares go back down. Right now I'm selling covered calls on it in my Roth. I'm actually hoping to get assigned. That way I can switch and bring that money to growth funds while stocks are down. But if the price goes down, I'll be looking to pick it up in my non-retirement account. A lot of people have given me flack about holding THICC in my Roth. They say this isn't suitable for a long-term investment. If that's your point of view, I encourage you to look at the price performance of THICC since 2011, when a $10,000 investment would now be worth about $1.5 million. I understand there's volatility decay and all sorts of things like that. Run your back test again, but this time sell covered calls on THICC, and then tell me what happens to your back testing. Just because it's in my Roth also doesn't mean I plan on holding it forever. I plan on holding it until I get bored of it, and then I'm going to switch over to THICC. By then, I should have a lot more shares of THICC because I've been selling covered calls on THICC. We could talk about that another time. Anyway, that's my dividend holdings. So, long-term growth company has a history of paying dividends. How can we find something like that? Fortunately, someone has done that work for us. We have a list of dividend aristocrats that meet two very strict criteria. One, it has to be on the S&P 500, so it must meet all those strict S&P 500 criteria first. And two, the company has to raise its dividend consistently for 25 years. Notice that the criteria don't say the company has to pay a high dividend. Lowe's Home Improvement is an aristocrat, but it isn't turning any heads with its 1.4% dividend. And there is still risk to this. AT&T is a dividend aristocrat, but it's going to cut its dividend this year because 7.6% dividend is too high for this company to pay out. But if you start by Googling the list of the year's dividend aristocrats, you'll be able to start a pretty good watch list. What if you just straight up don't have enough money to invest in dividend stocks? I mean, you've got some on this list that are trading for $150 or more. It might be unaffordable to you. Well, my advice would first be to remember that it doesn't really matter how many shares you have, it just matters how much yield you're getting. So if you have one share at $100 yielding 4%, that's the exact same thing as having 10 shares at $10 each yielding 4%. In the end, you wind up with the same amount of dividend. But I get it, you want to be able to reinvest your dividends, and that's really hard to do if you're only getting enough to buy 1/8 of one share every quarter. So if you can't do dividend investing, we can make our own dividends. I've been using userinterviews.com to make about $200 a month for a couple of months now. That's the exact same thing as having an extra $20,000 invested into QILD giving you 10%. Just sign up to a handful of focus groups every month, you'll get accepted to something, and you will get your money. Or if you're not trying to do focus groups over Zoom, then you can do Add a Poll for online surveys and probably make about $4 an hour. Or you can do free cash if you're into casual gaming, for which you get paid. And I have a video on this that I discussed during my freeloader challenge. If you just use these three things, you could probably make a good $500 a month. Right? That's the same thing as having an extra $50,000 invested into QILD. I'm not kidding. If you just reinvest that money that you get from freeloading into stocks, one day you won't have to sit around doing online surveys for 50% of minimum wage. You can just monetize your downtime by doing some of this and then use it to reinvest into dividend stocks.